Here's a question that trips up new investors all the time. If index funds and ETFs both track the same market index, why would you ever pick one over the other? The answer is more nuanced than most people think, and it could affect your returns by thousands of dollars over time. Let's dig into this. First, let's get clear on what we're actually comparing. An index fund is a mutual fund that mimics a specific market index, like the S&P 500, the NASDAQ, or the total stock market. It buys all or a representative sample of the stocks in that index so you get instant diversification without picking individual stocks. An ETF, which stands for Exchange-Traded Fund, does the same thing but trades like a stock. You can buy and sell it throughout the day on an exchange, just like Apple or Tesla. Now here's where people get confused. Some index funds are ETFs, and some ETFs track indexes, but not all index funds are ETFs. Traditional index mutual funds only trade once per day at the closing bell, while ETFs trade in real time throughout market hours. Think of it like this. A traditional index fund is like a store that only opens at 4 p.m. to sell its products, while an ETF is open all day long. Most people don't need that flexibility, but some do. Let's talk fees because this is where the real money lives or dies. Both index funds and ETFs are known for being cheap compared to actively managed funds, but they're not always the same price. Many ETFs have lower expense ratios than their mutual fund cousins. An expense ratio is the annual percentage you pay to own the fund. For example, you might pay 0.03% per year on a popular S&P 500 ETF versus 0.04% on an index mutual fund tracking the same index. That sounds tiny until you realize it compounds over decades. On a $100,000 investment, that 0.01% difference is $10 a year. But multiply that over 30 years and factor in compound growth, and you're looking at potentially hundreds of dollars in real money. Tax efficiency is another major difference most people overlook. ETFs have a structural advantage here. Because of how they create and redeem shares, ETFs can be more tax efficient than mutual funds. This matters most if you're investing in a taxable brokerage account, not inside a retirement account like an IRA or 401k. The difference becomes really noticeable when the market gets volatile or when fund managers need to rebalance. Index mutual funds can trigger capital gains distributions, which means you owe taxes on gains even if you didn't sell your shares. ETFs rarely do this, which is a genuine advantage. Now, there's a practical consideration. Most index mutual funds have minimum investment requirements. You might need to drop $500, $1,000, or even more to buy in. ETFs, because they trade like stocks, let you buy one share at a time. If you're starting small or dollar-cost averaging with small monthly contributions, ETFs give you more flexibility. But if you're using a robo-advisor or automatic monthly investing at your brokerage, many platforms waive minimums on mutual funds anyway. Here's my honest take for different types of people. If you're a pure buy-and-hold investor who's not touching your portfolio for decades, an index mutual fund inside a retirement account is perfectly fine. You get simplicity and low costs. But if you want the absolute lowest fees and maximum tax efficiency, especially in a taxable account, go with an index ETF. And if you're the type who might want to trade or rebalance during the day, an ETF gives you that option without restrictions. The bottom line is this. Both index funds and ETFs are fantastic ways to build wealth with minimal effort. The differences matter, but they're not huge for most people. What matters way more is getting started, staying consistent, and keeping your expenses low. Don't let analysis paralysis keep you from investing. Pick one, commit to it, and revisit in 5 years. Remember, disclaimer, this is not financial advice. Always consult a licensed financial advisor before making investment decisions. If this helped you understand the difference, please like this video, subscribe for more finance education, and drop a comment with your biggest money question. What's holding you back from investing? Let me know below.